Good afternoon. My name is Emmanuel Lecher, and it's a pleasure for me to host this new webinar today on asset-backed financing, factoring, and reverse factoring. Two experts from Redbridge's debt advisory team, Hugo and Matthieu Guillot, have prepared a quick market update on factoring and reverse factoring based on their recent conversation with factors in Europe. Hello, Hugo.
Hello, Emmanuel.
Hello, Matthieu.
Good afternoon, Guillot.
Hope you're all doing well. The idea today is to, present, I've been having an overview on why factoring solutions are worth considering in the current context of strong recovery. We will talk about the pricing structures, fancy topics also, such as ESG factoring, and we will also talk of a reverse factoring solution. For all our listeners, do not hesitate to send your question through the GoToWebinar console on your desktop. Matthieu and Hugo will answer them live right after their 20-minute presentation. I just wanted to say a few words on who we are just before handing the floor to my colleagues. Redbridge works hand in hand with corporate treasurers and CFOs to innovatively optimize their financing strategies, liquidities, payments, and treasury efficiency. Our teams are based in Houston, New York, London, Paris, and Geneva. We have a mission statement which is quite simple, and it reflects how we co-build every day some solutions with our clients. This mission statement is making an impact together, and making an impact together begins now with you, Matthieu, and with you, Hugo. So let's start.
Thank you, Emmanuel, and good afternoon to everyone. It is a pleasure to have the opportunity to give you an insight into the current state of the factoring and the reverse factoring markets. Thank you, Emmanuel. Why this subject appeared to us as a topical issue? Because we are living in a period of strong recovery of production, of activity and international trade, with impacts that can be significant on the working capital of corporates. Because the corporate's working capital is also impacted by the lengthening of payment terms. Because there is not a day that goes without a press article about the tension on supplies. Therefore, building supplier loyalty with a reverse factoring program can definitely make sense. And finally, because the bank financing market is evolving with a greater selectivity of lenders, especially during this period of crisis, such as the one we have just experienced, and with an ever greater focus on profitability. The preference of lenders will continue to be for secure financing, and in particular for asset-backed financing, because they provide better profitability and return for the bank, and offer better return and financing condition for the borrowers. Just one thing before we go a bit deeper into the subject, we want to remind you that factoring is no longer the financing instrument for companies having difficulties. All major corporates are interested in factoring. Why? Because it allows to finance your working capital, diversification of financing, off-balance sheet financing, optimization of cost of financing. That are all good reasons to look closely at the subject. Hugo, we can hear everywhere about off-balance sheet factoring. Who does it concern, and why is the subject particularly interesting for corporates?
Thank you, Matthieu, and hello, everyone. well, to answer your question, Matthieu, I propose to start with a few figures that show that invoice financing is definitely not limited to small or medium companies or distressed corporates. As you said, a large majority of European corporates use factoring mainly for off-balance sheet treatments. And this trend is accelerating. As an example, we have studied the sample of 95 large European corporates which publish clear information about their use of non-recourse off-balance sheet factoring. The deconsolidation of trade receivables represent on average at the end of 2020 0.43 times their EBITDA. That means that the impact on the net leverage ratio of this company is 0.43. Just for the sake of clarity, it's calculated as the ratio between the amount of balance sheet factoring to the EBITDA. So 0.43 at end 2020. On the same sample of corporates in 2018, the impact was only 0.3 times the EBITDA. So definitely a growing trend, and that has also been evidenced by the recent discussions that we've had with the main European factoring companies that report that on the mid and large cap segment, but also on the small caps, almost all of their new transactions are driven by off-balance sheet purposes. The number that came out was 95%. So now to summarize, corporates that are financially healthy can find several interests in using receivable financing. It's a source of liquidity, especially in the current context of increased payment terms. It's an alternative and low-cost source of financing, and we'll get back to this a bit later. And it is a way of managing its financial ratios with potential upside on other sources of funding, typically on a bank facility. It can include covenants or margin grids that are based on the leverage ratio. So it is a way to potentially gain a step, for example, on the margin grid. Now, really quickly, we wanted to draw your attention on the principles of off-balance sheet treatment under IFRS or US GAAPs. The idea is that for a receivable to be treated as off-balance sheet, all the risks that relate to this receivable, that's mainly credit risk, late payment risk, and dilution risk, all those risks must be transferred to the factor. So it's the concept of true sale of the receivable. The transfer of this risk is provided for in a number of clauses that can be found in the factoring contract. Unfortunately, at this stage, there's no real consensus on the drafting of these clauses. And from one firm to another, auditors have quite different approaches that are more or less restrictive. So our message here is that it's absolutely key to involve your auditor from the start of the project so that they're included in the negotiation and the drafting of the contract, so that you can make sure that you get off-balance sheet treatment of the operation. So maybe now that we've talked about the interest of such financing, back to you, Matthieu, for a few market news.
Yeah, thank you, Hugo. Maybe to start with, quick reminders of which are the main markets in Europe. The main markets remain France, Germany, UK, Italy, and Spain. As you can see on the slide showed on your screen, with factoring volumes in 2020 ranging from 182 billion euro for Spain up to 324 billion euro for France. The market has experienced a drop in factoring volumes in 2020. It's for Europe, the figure is minus 5% versus 2019. And since then, the market has experienced a rebound, but a slight rebound in H1 2021. That's the figures available, and the increase versus 2019 is 5%. So that can appear relatively low figures, but this is not a sign of corporates running away from this type of financing, but rather the sign of companies having accumulated a significant amount of cash as a result of, among other things, state-guaranteed loan and the implementation of the so-called crisis financing. As an illustration, we had a look at the cash level of listed companies in Europe, and it went up by 38% in 2020 versus 2019. So significant amount of cash, therefore less need of new financing. However, we are convinced that corporates are preparing for the futures. Refinancing, repayment of those loans being set up during the crisis, and that those new financing solutions will regain interest of finance departments. Some more news on the next slide, if you can, Emmanuel. Thank you. Second element that came extremely often in our discussion with factors and corporates is the fact that the structures of factoring program are becoming more and more complex, with clearly a trend towards centralization of program versus the setting up of several local programs. Factors are adapting themselves to this demand for international program, and they can now include transaction in Europe, but also in the US, Canada, or even Asia and Africa. So very much international program. The second trend that we experience is the fact that the credit quality of corporates is improving. Again, I cannot enough remind you that factoring is not the financing instrument of companies having difficulties. Any corporates, of good quality is looking at this solution, and this leads the factors to be more flexible with regards to the assets being financed. For example, the financing of overdue receivables. It is actually elements that needs to be negotiated on case-by-case basis with the factors. And finally, a sign of the appetite of the factors and of the borrower for this product is the fierce competition among the factors, which drives the pricing down. We've seen in Europe some programs having all-in cost close to zero. So definitely, a tool for diversification of your financing strategy, and also a tool to optimize your financing costs. Last trend we wanted to discuss is the today hot topic, being the sustainability linked financing, or more commonly called ESG financing. While ESG financing is common in the bond market and in the syndicated loan market, for your information, since the beginning of 2021, approximately 1/3 of the syndicated loan transaction in Europe include ESG criteria. The factoring market is clearly lagging behind in this area. However, the subject of ESG is important for many players, and some factors have confirmed having set up working groups on the subject. In the factoring market, given them lagging behind, there is no market practice regarding the mechanism for adjusting the cost of financing according to ESG performance. However, it is possible to imagine a mechanism similar to the one used in the syndicated loan market, i.e. a system of malus or bonus, depending on whether or not KPIs defined in the documentation are met or not. This mechanism should be discussed, validated as early as possible by the auditors, so as not to compromise the off-balance sheet treatment of the transaction. Remember what Hugo said earlier. I mean, all the subjects need to be discussed very early with auditors in order to ensure off-balance sheet treatment. The greening of the factoring market will be the result of the effort of the factors, and we just talked about it, but we are convinced that the corporates will also be important drivers, particularly those of you or those who in the market have already implemented ESG criteria on other financing, being bonds, private placement, or syndicated loan market. This is a vast subject that could be discussed at length, but I think time is running, and I suggest, Hugo, that we move to the second subject of this webinar, the reverse factoring, which we thought was important to tackle together with the factoring. Indeed, these subjects come almost systematically during the discussion we have with factors, and corporates are looking more and more into it. It is true, in certain countries more than in others. What we'd like to discuss during the next 5 to 10 minutes is the principle of the reverse factoring. What are the main interests for corporates to set up a reverse factoring program, and finally the challenges. Hugo.
Yes, thanks, Matthieu. I propose to start with a brief overview of the main principles of reverse factoring. So I'm sure this will be a reminder for most of our listeners, but it's just to make sure that we're all on the same page when talking about reverse factoring or supply chain financing. So reverse factoring is a financing tool which is made available to suppliers by their customers. So the customers are represented by, on the top left end of the diagram, as the buyer. From the supplier's point of view, such an operation is close to a factoring operation. The receivables being financed by a financial institution. You should note here that the financial institution can be either a bank, a factor, but also it could potentially be an institutional investor, a management company. Typically, there's a wide variety of funders. The interest of reverse factoring lies in the difference between the financing conditions applied to the buyer and those of its customers, of its suppliers, sorry. The idea being that the buyer allows its suppliers to benefit from its good financing conditions. It's an operation that involves a fairly important IT component because there's quite a lot of information flows. The buyer needs to approve the invoices issued by the suppliers. Those suppliers, then they need to be able to view that the invoices have been approved and potentially request for their early payment. All of this is usually done through a digital platform, which is a tool that can be provided either by the banks or by a third-party platform editor. So that's pretty much it for the framework of reverse factoring. And Matthieu, I will let you explain why and how it can be beneficial, not only for the suppliers, but also from a buyer's perspective.
Thank you, Hugo. 5 key interests for the reverse factoring. It allows to secure supplies by offering attractive financing conditions to suppliers. I mean, we're convinced that it is a way to build loyalty and to contribute to the health of your supplier, and make sure that your relationship with your supplier is good enough that it continues to supplies you, and given the current difficulties on certain areas, it definitely makes sense. It also enables to improve working capital by extending payment terms to suppliers, obviously within the limits of the local regulation and without burdening the suppliers. It's also a way to increase your margin. Indeed, you can negotiate potentially obtain discounts against an upfront payment to your suppliers. We're also convinced that it's a way to offer some of your banks side business. I'm sure they're asking for that, for side business, and knocking at your door every day. Reverse factoring is one of the side business that your banks will be happy to offer and to provide you. And last but not least, again, a subject that is extremely important to us, to Redbridge, the ESG dimension. Adding ESG criteria in a program, in a reverse factoring program, is a way to make the supply chain greener, with the implementation of incentive mechanism on the financing costs. So clearly, resulting in improving pricing for suppliers having virtuous ESG attitude. Shall we move now, Hugo, to the last subject, being the challenges to set up such a program?
Sure. Basically, the goal when structuring a reverse factoring program is to ensure that it's attractive to the suppliers for them to join the program. We have identified 4 key success factors, which are actually areas of attention when setting up such an operation. So the first one, that is also the most obvious one, is the economic dimension. The financing rate proposed to the suppliers must be attractive, and it's really important to keep that in mind when negotiating with banks and investors, even if the buyer is not paying the cost of this funding. It's borne by the suppliers, and it needs to be competitive from their perspective. The second aspect is the technological dimension. Why is it important? Because on a day-to-day basis, the reverse factoring program is managed from a supplier's perspective. It's managed through a platform, so the platform must be easy to use. And on that regard, the ecosystem is very quickly evolving, because the platform service can be provided by banks, but it can also be provided by external editors, as I mentioned before. Typically, those can be Kiriba, C2FO, Prime Revenue, but there are actually many other editors that offer various specificities. Another important aspect relates to the invoice approval process. So it's somehow related to the IT as well. How long does it take the buyer to approve an invoice? Let's say you have a 40 days payment term on an invoice. If it takes you 30 days to internally approve it, it really shortens the duration of the funding for the supplier, so it makes much less sense for the supplier. Now, from a legal point of view, that's another critical aspect, especially relating to the KYC for programs with an international dimension. the thing to have in mind is that depending on the legal framework, depending on the financial institutions that you'll be working with, KYC processes will be more or less heavy for the suppliers. And from our experiences, it has a significant impact on their level of enrollment. Finally, on the marketing aspect, it's absolutely crucial to have a strategy that needs to be defined with the procurement teams to communicate efficiently on the initiative and onboard suppliers. So to conclude, our message on this slide was that it's for a reverse factoring program to be successful, it must involve not only the finance department, but also procurement, IT, legal teams. Therefore, it's much preferable if it's sponsored by the top management. This is it for the presentation. Emmanuel, I'll let you conclude.
Oh, no, I won't conclude. We have received a few questions from our participants. Maybe let's start with this one, which is, I think, for you, Matthieu. You mentioned in the beginning of your presentation that factoring was not anymore only for distressed companies, but it looks like that the participant is a bit worried. Doesn't it send a wrong message to the clients when you sell the invoice to a factor?
Yeah, I think it's a very good question, and thank you to the participant having asked that question. It is, I mean, definitely a question being asked often by clients. Factoring, as we said several times during this webinar, is more and more common. So the clients of the corporate setting up that program shall not be surprised. But above all, factoring transaction can be completely confidential with their clients. The client does not have to be made aware. The payments can still be made on the existing account. Okay, there's not even a need to transfer to a new account under the name of the signer to the new banks. It can remain on the same account at the name of the signer. Okay. And the factors mandate the signer for the recovery process. So there is absolutely no impact whatsoever vis-à-vis their clients.
Mm-hmm. Yeah, pretty clear. Thank you, Matthieu. Hugo, I have another question, which is for you this time. What about off-balance sheet treatment of factoring in local GAAP?
Thank you, Emmanuel. Well, it's not really easy to answer, given that there's a diversity of accounting standards. So I wouldn't be able to give a specific answer, but generally speaking, the IFRS standards are pretty restrictive, not to say the most restrictive. So usually it's easier to get an off-balance sheet treatment in local GAAP. And you know, I was referring to different risk related to a receivable. Basically, you usually, from our experience, in local GAAP, the consolidation is mainly linked to the transfer of the credit risk to the factor. But again, our message is the same, either in IFRS, US GAAP, or other local GAPs. It's absolutely essential to onboard the auditors and include them in the negotiation of your factoring contract.
Mm-hmm. Thank you, Hugo. I see that it is 4:30 p.m. Maybe if we have time just for two more questions. Are you okay?
Mm-hmm.
Okay. This one is for you, Matthieu. From an operational standpoint, is it easy or very difficult, I mean, to implement a factoring program?
Well, again, a question that is very good and very often asked by corporates. Factoring can be a bit heavy at launch, in order to set up the IT files to be sent to the factor, reconciliate the amounts assigned and finance. Okay, so a bit of data crunching, which can be heavy. However, once it is up and running, it can be pretty light. We've discussed and got some feedback from a number of clients, and the information we gather is that it takes from half a day per week for one person to 2 to 3 days a week, and also it definitely depends on how the program is set up, whether it's one country or several countries, number of subsidiaries, and the IT reporting system. Okay, but let's keep as information that if it's rightly set up at the beginning, it can be pretty light and pretty cheap financing.
Mm-hmm. Okay, thank you. Last question, Hugo. Is there a minimum size or a minimum rating to set up a reverse factoring program?
Thank you, Emmanuel. Well, theoretically, there is not. And to illustrate that, some actors in the reverse factoring field have appetite even for small operations starting from a few million euros of outstanding. However, in our opinion at Redbridge, there's a quite important structuring cost to such programs. Not so much of a financial cost, but more in terms of implication. It's a quite heavy process. It's quite long to set up. I would say at least 4 to 5 months, and in many cases more than half a year. So it needs to make sense to invest time on such a project. Now, from a rating perspective, the only thing that you need to keep in mind is that first, the funding cost proposed to the suppliers needs to be competitive. So it's not really a matter of rating, of absolute rating, but more of a matter of relative rating compared to the suppliers. And actually, quite a few buyers have below investment grade ratings. And the other point is that if you're working with banks on a reverse factoring program, from their perspective, it would be seen as additional exposure on the group. So it could have an impact on the availability of other financing. So that also needs to be kept in mind if liquidity coming from bank is a matter of attention of the corporate setting up the program.
Okay, good. Thank you, Hugo. Hugo, Matthieu, I mean, it's always a pleasure to discuss with you financing trends and important matters for the CFOs and the community of treasury professionals. We talked about ESG factoring today very briefly. That was part of the presentation, but I really feel that it would be great to meet soon, maybe on this broader topic of ESG financing. And well, I hope that you would accept my invitation to meet again on ESG. Are you okay?
Always.
Thank you very much to all the participants of this webinar, and let's meet soon. Hope you had a great time. Do not hesitate to contact us should you want to have any further information. Hugo and Matthieu are there for you. Have a good day. Bye-bye.
Bye-bye.
Bye-bye. Thank you.